Hello investors, welcome to Simpli Stocks. To take advantage of the ongoing market correction at Simpli Stocks, we have started a series of 7 stocks where we will study 7 companies one by one that have strong fundamentals, solid business models, and a clear moat. But these companies have corrected quite a lot due to the ongoing geopolitical tensions. The intent is that since these are unique or large enough businesses, they will be able to easily pass this phase of uncertainty of whatever 3 to 6 months. And once things stabilize, these businesses will emerge strong again in the future. As we will study these businesses, our focus will be less on quarterly results and we will place more emphasis on the business model, its moat, positioning, and also industry structure. My name is Vikalp Mishra and I am a SEBI registered research analyst. And in this Stocks for Market Correction series, the first business which we will cover today is Eternal or Zomato. So without further ado, let's begin. Firstly, at the outset, let me break a myth that Eternal is not about Zomato or its food delivery business anymore. The main trigger in this stock now is Blinkit, which is their quick commerce business. Eternal has 4 business segments. First is Zomato, which is their food delivery business. Second, for quick commerce, there is Blinkit. Third, Hyperpure, which supplies groceries to restaurants and hotels. And lastly, District, which comes under the going out category. Out of these, food delivery and quick commerce are the main business segments, but the growth in the food delivery business has slowed down. The sector itself is not growing very fast right now. Both Swiggy and Zomato are seeing sales growth of around 15 to 20% for their food delivery business. At the same time, due to the LPG shortage, what has happened is many restaurants are not able to operate at full capacity. So because of this, there is a negative sentiment around Swiggy and Zomato because of the gas shortage and that it is going to impact their business. So all in all, because of that, both these stocks have taken a hit. They have fallen significantly. But here is the thing that you need to understand, that if Zomato is not even the main trigger for Eternal anymore, then why are we taking this problem so seriously? This gas shortage issue which is there, which is affecting restaurants operations, is temporary in nature. At some point of time, the situation should get better. But because of this very uncertainty, the stock has corrected and is now available at lower valuation, thus creating a long-term opportunity for investors in Eternal, which was not there earlier. So you need to think on a forward basis with a 3 to 6 month outlook. And personally, I believe while individual restaurants may be affected due to this gas shortage, aggregators like Swiggy and Zomato are actually in a better position. Think of it this way: if you go to order your favorite dish from a restaurant and it is not available, either you will switch the restaurant or you will order something else. Order volumes will get impacted. Yes, that is the case for Swiggy and Zomato, but I think not that significantly. Customers always have options on Swiggy or Zomato or platforms, so they will simply shift to another restaurant or another item. And another reason for the correction is the entry of Rapido in the food delivery space. Rapido has already disrupted the cab aggregation market by breaking the duopoly of Ola and Uber. So yes, we will have to see how competition plays out, but this is not a big concern as of now right away. Swiggy and Zomato, I think, will do needful to do whatever to maintain their market share. But overall, our focus should be on Blinkit because that is the main trigger in this stock. You will see here that quick commerce has already become larger than the food delivery segment and it is still growing at a rate of more than 100%. On the other hand, growth in the food delivery business has slowed down. At the same time, losses have also reduced. If you look at this screenshot, earlier for 3 consecutive quarters, Blinkit was generating EBITDA losses of more than 150 CR. But in the latest quarter, it has reported an EBITDA profit of around 4 CR. This means Blinkit is moving towards profitability. However, what happened is that when the Q2 FY26 results were announced, the stock was at its all-time high. At that time, competition in quick commerce was very intensive. It was at its peak. That is why after the Q2 results, I myself exited from Eternal because honestly, at that time, it did not make much sense to me to stay invested here because valuation looked premium, very high, and competition was also intense. because from Instamart to Zepto, every player was throwing money. When competition increases, what happens is it directly impacts your margins. So there was risk that EBITDA losses would either continue or they would go up. And in fact, I clearly remember the timing also. I exited Zomato around 10 to 11 October, 10th and 11th October. But since then, things have improved quite a lot. Margins have become better for the business, and the market also has more clarity now. Also, due to the correction, the valuation has again become attractive again. So after the Q3 results, I have again started tracking this business very closely. Now, a humble request, just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simply Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Coming back to our discussion, so far we have understood that for investors, the main trigger in Eternal is now their Blinkit business and not Zomato. Recently, competition in quick commerce sector had also increased quite a lot, and Blinkit's losses were also not coming down. But now we are seeing some signs that a few players are starting to control their cash burn. Along with that, Blinkit has become EBITDA positive, which is a very important development for this stock. Now, we will understand a few more points or things one by one, like how is the competition in the sector right now, what are the industry dynamics, and so on. After that, I will bring together all these points and give you a clear summary or conclusion. So please listen to me very carefully because all these points are interconnected, and try not to miss anything. So, all right, first let us look at the competition in the market. So, Amazon and Flipkart have also entered the quick commerce space. Then you have Big Basket, which comes under the Tata Group, and Reliance JioMart. These are the large corporates with strong backing. After that, you have independent players like Zepto, Swiggy, Instamart, and Blinkit. And now even DMart is gradually entering the quick commerce space. That is about the competition. Now, customers can be divided into three categories or three types. First are your new users who are using these apps for the first time. Second are your mature customers, or these are your loyal customers. They usually stick to one particular platform for their purchases. For example, I personally like Big Basket, while I know some people in my circle for whom Blinkit is their go-to platform. So these are the users who don't switch frequently because of the discounts. These are the loyal customers or loyal users. And lastly, the third type is multi-apping users who keep visiting this or that app in the search of discounts or low prices. These users have low loyalty and high churn. They simply go wherever they find better discounts or more flexibility on low order value. Now, the problem in this sector is, as you can see, there are around 8 players operating in the quick commerce space, and they mainly compete in two ways. One of them is by reducing the minimum order value or your MOV. For example, Flipkart Minutes is currently offering free delivery at just 100 rupees. Now, think about it for a moment. If a company is delivering anything, say milk, curd, butter, or whatever at your doorstep for just 100 rupees, after paying the delivery partner, what is the company even really earning? It basically means Flipkart Minutes is operating at a loss intentionally to gain market share. So that is the first way to compete. And the second way to compete is heavy discounting on whatever products you are listing on your platform. But the issue with this kind of competitive behavior is that loyal customers don't switch easily. Flipkart won't be able to take away those users or say those many users of Blinkit or Big Basket. And in reality, it is mostly the multi-apping users who keep switching between platforms. They will go to Flipkart because of the minimum cart value or discounts. So companies are getting a false sense of market share gain by doing all these things. They feel they have acquired customers by taking losses. But the moment they reduce discounts or increase the minimum cart value or order value, those very same customers will move somewhere else. So right now, many players like Zepto, Instamart, and Flipkart Minutes are not even profitable at the contribution margin level because of these, let's say, delivery charges or heavy discounts. They are running in losses. Now, how these players are trying to counter this? So Zepto and Instamart are now prioritizing profitable large orders over just growth. But how do they do that? So the first option is always order batching. For example, if three customers place orders, one single delivery partner picks up all three orders and delivers them one by one. But the problem here is that the customer gets irritated. Obviously, the app initially shows a delivery time of say 10 to 15 minutes, but due to batching, the delivery gets delayed. The second approach is to push customers to place larger orders. But here also there is a problem of building a bigger cart because it takes time. If I ask you to quickly order something, say besan or gram flour, you will probably say, tell me what else to add for 500 rupees, right? Because then either you or I will have to go and check the kitchen to see what else is required or is about to finish. But then there the competition comes in from the slotted delivery players like Big Basket or DMart, which are doing a better job. Plus, in that case, the value proposition of quick commerce is no longer there because it is taking you time to order whatever you want to order. So the sector itself has reached a point because of this heavy competition where customer habits have changed for bad. Now, if the order doesn't arrive within 10 to 15 minutes, customers get irritated. At the same time, the moment companies roll back even slightly on discounts or incentives, multi-apping users immediately switch to another platform. So that is why, looking at all these problems, I personally like Blinkit more because it has moved beyond all of these issues. Blinkit has always positioned itself as a premium quick commerce player. If I give you an example, like if you go to Big Basket or Swiggy Instamart, you will often find small value items like say 5 or 10 rupees biscuit packet, or basically smaller SKUs. But on Blinkit, you will notice that products are usually available in larger packs or bigger SKUs only. So Blinkit has structured its assortment in a way that customers' cart size automatically becomes larger. Plus, their customer base itself is slightly, I think, different. By targeting the premium high-end segment of the population, they have built strong platform loyalty. Blinkit has a higher share of loyal or matured customers, basically people who prioritize convenience over price. And lastly, their product assortment is also quite good because from the beginning, Blinkit has been a first mover in many categories. Like you would remember whether it is the printout service or even delivery of products like iPhones. So initially, when Blinkit introduced these categories, they were trolled. But today, people are actually using these services. So their assortment is also so strong. We can say that if something is not available elsewhere, you know that you would definitely find it on Blinkit. So which we also call fill rate. So all in all, Blinkit has a strong fill rate, and all of this gets reflected in their numbers too. Like I will show you moving on. If you come and look at this screenshot, you will see that their store count has doubled compared to the last year. Now they have more than 2000 stores and their target is to open 1000 more stores by March 2027, taking the total to around 3000 stores. You will also notice that their average order value per day or AOV per day per store is around 750 rupees, and this is actually without pushing customers to place larger orders. So that is something interesting. The number of orders has grown by 121% year on year, increasing from 11 CR to 24 CR, and their contribution margin is around 5.5%. The most interesting part is that Blinkit has now reached EBITDA break-even, meaning it is at a no profit, no loss stage. You can also notice that when competition increased earlier, losses had gone up, but now things have stabilized. Zomato was already profitable, and now with Blinkit reaching EBITDA break-even, the company has moved way ahead of its competitors. Let's move ahead. So here you will see Eternal currently has a cash balance of around 18,000 crore rupees, which gives a strong moat to the business. Earlier, there was a perception that traditional retailers or say large e-commerce players could easily push out quick commerce companies because of their strong backing. But now almost all players are adequately funded. Zomato has a cash balance of around 17,800 crore rupees. Swiggy has about 15,900 or say somewhat around 16,000 crore rupees. Although Zepto is at the lowest at around 8,000 crore rupees, which is why they are a bit desperate also to chase profitability. Swiggy had raised funds via a QIP and also sold their stake in Rapido, which got them good amount of money. So now every company has a strong war chest, and players understand that doing aggressive marketing won't really benefit them anymore. Everyone has deep pockets to fight a long war. But the advantage with Eternal is that actually it is generating surplus cash. From here, Eternal can easily generate, I think, around 200 crore of surplus cash every quarter. You might see some investment in working capital, but that is temporary. The company has shifted from a commission based model to owning inventory, which will improve margin by around 1%. So that is why you see this investment in inventory that has gone up. But apart from this, another thing which I like in Blinkit is that it is not just focusing on profitability anymore. They are also investing in warehouse and supply chain automation. So overall, if I summarize, Blinkit's positioning is stronger compared to other players in the market. It is no longer burning cash heavily. Plus, among the three independent players, Blinkit has the highest cash balance, which provides it a strong war chest. From here, I believe that quick commerce segment will remain obviously competitive, but each player will eventually settle into their own segment. Big Basket, Geomart, and Dmart are likely to do well in the slotted or 1 to 2 hour delivery models. Amazon and Flipkart are still in early stages, so their positioning is yet to be seen. On the other hand, Blinkit has already cornered the loyal, matured, and premium customer segment, and it is likely to continue doing so going forward. So, in the short term, competitive intensity may keep fluctuating, but what you need to focus on, which player has a stronger moat and better cash balance so that they can outlast this short term competitive intensity. You also need to track how fast this cash is being spent. Like Blinkit has an advantage here too, especially because when you see Swiggy, it is still burning a lot of money. So in the long term, I believe Eternal can emerge as a strong player, and it should. Quick commerce is a highly execution driven business, and over time, inefficient players will exit the market. You can track Eternal, although valuation may remain tricky because competition can vary over the next few quarters. But you should closely monitor store expansion, contribution margin, EBITDA margin, and also cash burn. You need to understand here the direction of the business, I will say. Don't remain too fixated on the valuation part, because one thing is clear: if you look at the business model, Blinkit is clearly much more differentiated and stronger compared to the other players in the market. Now, in the end, I hope you found this video helpful. And if you did not like the video earlier, please do it now. This will help me to know if you are enjoying this stocks for market correction series or not, so I can bring more such videos for you. And if you have any doubts or queries regarding the stock, you can surely ask them in the comments. I will try my best to answer all of them. So I will see you in the next video. Happy investing.